What's going on, everybody? Welcome to the Honest Earnings Podcast, where we talk about personal finance, investing, financial literacy, and entrepreneurship. Today, I'm joined with David Masias, a financial advisor with Merrill Lynch, somebody very knowledgeable in this domain. Welcome, David.
Thank you for having me.
Absolutely. So, I wanted to bring you on to talk about a lot of topics about personal finance that could help people out there who have questions, concerns with their own personal finance journeys. So how about you give a little introduction for yourself?
Yeah, I was in the military for a couple years, and I went to college here in Los Angeles, where I got my degree in finance. For the first couple years, I was really heavily involved in the nonprofit scene, helping with capital finance raising, business development, things of that nature. And Merrill Lynch reached out to me and asked if I wanted to join them in a program as a financial advisor, and I've been doing that for the past 3 years.
That's very nice. So I guess financial advising would be your passion, and investing, all that kind of stuff is something you're very, passionate about.
Investing's always been a passion of mine. I love the study of value of things. Is it worth as much as it is? In college, I did a lot of day trading and swing trading.
Oh, you did.
That's where I kind of, broke into the ground on more on the technical analysis side of things. Now I focus more on the fundamentals of a company and with a long-term view of investing.
So for a beginner investor, what would be the best strategy for investing? Would you say passive investing, holding long term, day trading, swing trading?
Well, first and foremost, it's always best to be a buy and hold investor, unless worst case scenario is the company's falling apart, going downhill. I definitely wouldn't advise swing trading or day trading unless you do a lot of homework. I spent 6 weeks learning everything I could about that, and I was fortunate enough to even break even in that space. It's day trading, swing trading isn't investing; it's trading.
Mm-hmm.
There's a fundamental difference between investing for a long term for your retirement than it is to make a quick profit.
Okay. So when it comes to buying and holding, what strategy would you say is the most important in terms of what kind of assets people should be adding to their portfolios? Should people be into ETFs, index funds, mutual funds,
It's all about
individual stocks?
it's all about your comfort level. Depending on how much time you have to research, to monitor, funds might work better, or passive investing. ETFs is a good way to get broad-based diversification. Same with mutual funds. Individual stocks is where you'll see the most returns over the long term because you're investing in an individual asset, so it's not as diversified, so your returns are more pronounced. And it's all about what your comfort level. I could tell you, the best investment strategies, or I could show you, but if you're not able to sleep at night comfortably, you're always worrying, then it's not the right investment for you.
Okay. Well, yeah, that makes sense. So a lot of people would then have the question, should I be a solo investor or should I use a financial advisor? Under what circumstances would either make sense?
I would say, one of the number one advantages of having a financial advisor is that the emotional aspect. Even for myself, when it comes to certain financial planning, utilizing, my accountant and stuff, it's best to have a third party take a look and give you an honest assessment of what you're doing. Is it correct? Is it aligned to your actual goals? If you have another person that's able to look at you, what's going on in your life, family issues, things of that nature, they're able to help readjust, reallocate that portfolio.
Mm-hmm.
That's what I would say, at least, so that when it comes to individual investing, and I tell my clients that are extremely intelligent, extremely well off, it's about the time that you have to put in it. You generally have other things that you like to do. You want to be able to focus on what made you successful, that brought you here, and usually it's best to utilize a financial advisor at the time. And then lastly, a financial advisor could open you up to so many more investments and strategies that you can't get access to as a solo investor. There's one strategy I'm not going to talk about, but for an individual person going on his own, he would need $5 million to buy in. Going through me, you only need $50,000.
Wow, so that's a big advantage in going through a financial advisor.
It is.
The lower barrier to entry.
Exactly. You get more access to more sophisticated investing. Um, it's all about the access and how much money it costs to get in certain strategies.
Okay, so what are some things somebody should consider when looking for a financial advisor or a firm that could help them?
Yeah, the number one thing I would say is, do you trust them? It's all about trust and their relationship in this business. Pretty much every brokerage firm or financial advisor firm are going to offer the same nuts and bolts when it comes to financial planning and investments. And so ultimately, you have to realize that if you're comfortable working with this person. Does he give you enough attention and detail that you require, that you want? A lot of times, and this is a problem within industry, especially with older financial advisors, is that they'll bring on a new client and they already have their set portfolios or investment strategies. And if you don't perfectly fit in one of these 4 or 5 portfolios, well, you're out of luck. He's not going to change the way that he invests. You're going to fit in it or you're not. And then another issue is that you see a lot of times I bring you on board, not me, but a financial advisor will bring you on board, and they maybe talk to you once or twice a year.
Damn.
You know, they got your money, they're investing. You might be doing great, but, you know, they're not going to spend that much time with you to explain how things are going, you know, to really learn about what's going on in your life and make sure that you're on track.
So how often should you be talking to your financial advisor, or how often should your financial advisor be talking to you? And what kind of conversations do you have with your clients when you first sign them?
Yeah, no, that's a great question. And a lot of clients that I bring on board, you know, ask that very same question. And I tell them, you know, one, I generally talk to all my clients at least once or twice a month. And a lot of times it's not even about their finances. It's just to, you know, see how they're doing, what's going on. It's really focusing on that relationship, being a part of that family. Because there might be times where, you know, they might be losing a job. There might be a health or illness situation coming up. You know what, maybe let's pull back in certain investments. Let's make sure we have that liquidity. I think generally what's best if we're just focusing on the investment side, at least once a quarter, you probably want to talk to your financial professional, just see how things are. You don't even, you know, necessarily need to reallocate, but let's just make sure that you're on track. And what I mean by that is a lot of people, when they talk to a financial advisor, they ask, how much money can you make me? Can you do 20%? Can you do 30%? And that question is really hard to answer because it all determines on what you're trying to achieve. When you first, you know, when I first look at a client before I onboard them and we invest, you know, we have to see where they are financially, you know, debt, how much money do they have? What is your ultimate goal with this money in the next 20, 30 years? And so say they have $1 million, they tell me the lifestyle that they want in 30 years when they retire, and we work the math, then they only need $2 million. So they only have to double their money. Well, you don't need an investment or a strategy that gets you 10, 15, 20, 30% a year. You'll double your money using that within 5 years, but you're also opening up yourself to a lot of volatility, a lot of downside risk. And so in that case, if you have 20, 30 years to double your money, you know, you might want to go on a very, very conservative portfolio, you know, that helps you sleep easy at night. You know, slow, usually, you know, it's the slow grind or the slow turtle wins the race or something like that.
Okay. So a lot of people out there would probably be saying, hey, I have debt and I don't know if I should invest right now or pay off all my debt before I invest. How would you advise somebody who has a significant amount of debt but also wants to start investing?
The number one question I would ask them is, are they able to invest with still being able to pay off that debt, or at least make the minimum payments? The biggest issue always is when it comes to debt to investing is what's the interest rate that you're paying on your debt. If you have credit card debt that's 20, 30%, you should probably focus on paying that down
good
first.
Luck with that.
You know, but if you have a mortgage, student loan debt, it would make more sense to make the payments on time, the ones that you have, and then you invest, because it's not unrealistic that over 5-10 years you could earn, you know, 10% annually.
Okay. Yeah. So then I guess it leads to the next question, which is, how much money should you have before you invest? A lot of advisors or people in the financial industry will tell you that you need to have a certain amount of money, like a savings account that has a certain amount of money for a rainy day or something like that. how much money would you advise somebody to have as a cushion before they can comfortably start investing?
Yeah, that's another great question, and a popular Dave Ramsey's.
Yeah.
People who probably listen to this have known him, and I think he has a lot of great things to share. Generally the emergency fund, you want 3 to 6 months worth of living expenses, and then once you achieve that, whatever money, it could be $100 or $1,000, invest it, and how much money you have at first to put in on a monthly basis will determine what kind of investments are available for you. Because you can't buy Amazon stock if you only have $1,000 a month. You have to maybe look at ETFs, mutual funds, or individual equities that have a lower cost basis.
Okay. So a lot of people are regular working class citizens, have a regular job, have 401k, and a lot of people don't know about, how beneficial a Roth IRA might be in comparison to a 401k. So what are the pros and cons of a Roth IRA as opposed to a 401k as investment vehicles, like retirement investment vehicles?
Well, the biggest difference with a 401k compared to any other investment vehicle in general, IRA, Roth IRA, things of that nature, even a DB plan, is a 401k, you have a set of investments that is made to you. You have a very small selection. They're usually mutual funds or ETFs. So there's a lot of fees hidden inside there. Your selections aren't that great. When it comes to Roth, obviously that is a tax-deferred growth. Same with the 401k. The good thing is if you're able to invest in a Roth IRA, when you pull that money out for retirement, it's completely tax-free. Unlike a 401k or an IRA, you use pre-tax money to lower your tax liability every year. You allow that money to grow tax-deferred, and then when you pull it out, when you're ready to retire, you're going to get taxed at whatever income level that you have.
Yeah, that's a really important point you made. I think a lot of people should consider the fact that if you put money into the Roth IRA from a young age, you can have a lot of money accumulate over time in that account. So the point you made was amazing.
Yeah, Roth IRA is definitely the better vehicle when you're younger, when you don't have to pay that much in tax income. So if you're in, let's say, $30,000 to $100,000 range, a Roth IRA would make sense. There is thresholds to the amount of money you can make to contribute to a Roth IRA, but even if those thresholds weren't in place, if you're a $200,000-$300,000 earner, a 401k could lower your taxable income by at least 10-20%. There's other ways, and so that makes more sense. And generally, if you're making $300,000-$400,000 a year, you want to lower your tax liability as much as possible in present, because when you retire, you're not gonna be making that much. And so maybe you build up your retirement account where you could pull out $150,000, and that's a huge difference in tax liability than someone who's earning $300,000 or $400,000.
So how do you help people lower their tax liability?
So it depends on the way that they earn their income. If you're a W-2 earner, there's almost nothing you can do besides just fully contributing to your 401k. What you would really want to do, if you want to be able to lower your tax liability, maximize the investments you can make in a qualified plan. A qualified plan is any type of retirement vehicle. Then you want to be a 1099 employee. I know a lot of people, don't necessarily like that, or there's a bad stigma to being 1099. But it grants you the most freedom possible in handling your finances and investing.
Okay. So when it comes to choosing assets, for your portfolio, would you say, what's your thoughts or opinions on stocks versus crypto right now? Crypto is very hot. Everybody is very into it. What's your advice on that?
There's no comparison. Crypto is not an investment. That's a trade. The reason why is, and we're just thinking about it logically, what does money do for you? It's a monetary tool of stored value of one's labor. Crypto doesn't achieve that. You would not be using a dollar if you thought the dollar would double tomorrow. It wouldn't make sense.
Very true.
And crypto, there isn't any fundamental basis to it. I know people are very enamored with Bitcoin. It's an artificial, finite, digital instrument that only has value because someone gave it to. Now, you can make the same argument for a lot of equities and stuff, but there's no fundamental reason to for it to be worth 50,000 or 100,000. There's really no difference.
So the volatility in things like Bitcoin, you say, are kind of risky, right?
It's definitely risky. If you're an individual, investor and you're looking for long-term growth, if you want to invest in Bitcoin, and I have a lot of clients who ask, use your throwaway money, your gambling money. We all have a little bit of a checking account or something that we don't really care what happens to it. And so throw that part of the money into crypto, and then let's invest intelligently with purpose and diligence, with the rest of the money that you're going to rely on for retirement.
So what are your thoughts on Robo Investors, all the new ones that are out there, like Robinhood, you have M1 Finance? What are your thoughts on people using those to invest?
Robo, advisor, I mean, it's going to hurt me, but they're all right. The issue with that is that you're going to answer a bunch of questions. It's going to develop your risk assessment and things of that nature, like, oh, maybe you should be 60-40, 70-30, and it's going to just spit out a generic portfolio that will generally do all right over the long term. Investing is as much about the emotions as it is about the finance aspect. And I'll just relate back to what I said earlier is one, it's important to have someone that understands what's going on in your life, what circumstances are impacting your future. Like I say, maybe you get sick, maybe you have a new promotion, or COVID happened. A robo advisor isn't going to tell you, like, you know what, maybe it makes sense to pull back a little bit, maybe pull out a little bit of money, or let's go into fixed income. A robo advisor isn't going to be there to guide you through all the ups and downs of your life and the market.
Okay, yeah, that makes a lot of sense. What are your thoughts on the volatility in the market right now? And do you think people should be doing their fundamental and technical analysis before buying stocks?
Well, I mean, when it comes to technical analysis, you only use that on a short term. Technical analysis only works within, the minute to maybe up to 1 year. The volatility that you see now is a unique feature of how this March recession happened. It's the first time ever in American history that disposable income has gone up, that savings have gone up. People have made a lot of people have been able to go through this experience and with more money than they normally would have, flush with more. And when you're staying at home, you could only buy so much stuff on Amazon or e-commerce, and so you want to get in investing, you hear about it. The issue, and there's a lot of articles about Robinhood, is Robinhood makes it into a game, a casino. They know how to do flags and balloons when you make a purchase. They make it extremely difficult to cancel a trade. And that's where you see a lot of volatility. I 100% support people investing and being involved in it, but I would also just say, invest with a purpose, know what you're doing, and understand the risk involved.
Okay, so you mentioned people investing based on emotions. What are your thoughts on advising people in how to invest without emotions and investing and making smart investment decisions?
Well, almost all investment is emotions. What I would count as like negative emotions is people who got caught up in the GameStop, the BlackBerry, Dogcoin or Dogecoin. I don't know how you pronounce it. Dogecoin. Yeah. That's emotional, in a negative way. A lot of times people would want to invest on, say, for ESG levels. It might be religious reasons, things. That's also emotional, but it's not necessarily bad. It's all about what you're comfortable with. And, do you support this company? Do you believe in it? Things of that nature. Okay.
So when you first take in a client, how do you assess their finances, and how do you allocate resources, your own resources, in helping them?
Well, and this is probably the same across most brokerage firms, is what we call it a discovery. Just see, what are we working with? Sometimes the client tells you everything, or they're like, this is the amount of money I'm going to give you. Yeah, I'm not going to tell you about anything else. And then at that time, you have to decide, what is the purpose of the money? Is this for a down payment in a home in the next 2-3 years? If so, we're not going to be investing in the market. That's extremely dangerous and volatile and not a smart move. Maybe it's for 10 years. All right, you could have some equity exposures, but maybe it's going to be more like 60, 70. And it depends on how much money you need to make for that goal.
Okay. So you mentioned earlier that you have $1 million clients and you have regular, people who make the average salary. So what's the main difference in how you advise um, the two parties?
Almost none. The difference in when you start advising clients
Mm-hmm.
is you have to generally get into like 7, 8 figures or even 9 figures. And it comes to legacy planning, preservation of assets. Someone who already has $10 million, they're not going to be all in on the S&P 500 or have that much equity exposure generally. It's about, let's get a nice safe yield or total return on this. How can we avoid the taxes on me trying to pass this along to my children? Um, my job, a small part of my job is actual investing. There's a lot of planning and transition of these assets and how it's going to affect the younger generations, and create a legacy plan. And the issue that I've found while in the business is that a legacy plan, a trust is a dime a dozen. Anyone can get those easily. But what's important is having the appropriate financial advisor or lawyers involved that educates each person in that family on what their role is and kind of handle this money and what to expect. There's a huge problem that a lot of people don't realize that, just say, for instance, you became a billionaire tomorrow.
Mm-hmm.
The chance that your wealth is going to last past your great grandkids is less than 10%. And so, the problem nowadays is that people will inherit money and are unwise with it. We're not putting up safe rails. And so that's part of my job.
Okay. Well, yeah, it's important for people to understand the reach of their money and how to preserve that money for generations to come. And one of the things that a lot of people might be wondering is how they can save money while eliminating the debt they have and investing. So one strategy that I've seen is something called the CEO strategy, which is cutting your costs, earning more, and optimizing your spending. And the middle one is a controversial one because somebody can say, how am I just going to earn more when I have no more skills to give me a better position to earn more? So how can people do the first and the last, cutting costs and optimize spending? And how can people improve their skills to earn more?
Well, cutting costs is taking a complete financial look of your monthly spending, say the last quarter, and seeing where that wasteful goes. Everyone likes to bag on like $10 Starbucks. So that would be a great start, looking at that. When it comes to debt, like I said, the most important thing when it comes to debt is the interest rate. There's good debt, like your mortgage, your student loans. Sometimes how you leverage your assets could be good debt. And then obviously the bad would be car loans, definitely credit card, things of that nature. And so when it comes to cutting costs and trying to manage your debt, you have to see, is this dollar that I'm going to put towards this debt, is it going to do more for me paying the debt off, or is it going to do more for me sticking in the market and let it earn twice as much than the interest that the credit card company or whatever debt I'm worried about paying off?
All right. So a lot of Gen Z millennials are finding it hard to, be able to put themselves in positions to buy houses and stuff like that. So how can people who are younger position themselves to be able to make those kinds of moves, not like when they're 50 years old, like earlier?
Yeah, well, one way is definitely if you're younger, you generally have a little bit less responsibilities. You have more freedom to move, to chase after that job, to take risks, at least business wise. And the earlier you start investing or savings, the better it is and easier for you to put down a down payment. And there's a lot of great tools out there, government programs, VA loans if you're a veteran, FHA loans. There's at least a half a dozen different first-time home buyer programs that you could utilize, and that coincides with finding like a great realtor and talking to a third party just about your finances and what makes sense. And a lot of people don't realize a bank or a lending facility is generally going to offer you more than what's in your best interest. And so you might qualify for a $500,000 loan, but looking at your finances, you should really only take $400,000. And so that's why you want to talk to a third party, take a look at your finances right before or even a couple years prior.
So what would somebody's finances have to look like where if they were approved for $500,000 loan, they would need to take a $400,000 loan instead?
That's a really interesting question. I would have to look at that person who got qualified for a $500,000 loan. Same with getting a car. It's really easy to get a car loan. And they'll let you get the most ridiculous car payment and say, oh, you'll be fine, because like I said, it's not in their best interest to be honest with you on the car payments, because ultimately if they oversell you on a loan, be it a home or a car, you'll make those payments until you can't. You'll struggle. You'll go into default, and they'll just repossess the home or a car. So either way, they're making out like a bandit.
Okay. So when somebody, gets their paycheck, they work regular 9 to 5, what should be the first move they make with the money? Should they put, what percentage should be put into savings? What percentage should be put into paying out bills, etc.?
It all depends on your lifestyle. I was having a discussion with my business partner last night, and I'm going to go a little bit sidetrack on this. And we were talking about the FIRE movement, and I'm sure a lot of your listeners are familiar with that. And him and I were discussing, does it make more sense to say, enjoy your life, say you make $300,000-$400,000 now, enjoy it, live it to the fullest with the experiences while you're young, you're healthy, and then when you retire, all right, maybe you can only live off $100,000. The FIRE movement is the exact opposite. And when it comes to retirement planning, should I live as frugal as possible? Put 20-30% of my my paycheck into savings account, invest in things of that nature. And so it's really up to your time preference. And ultimately, and the best advice I'm sure everyone hears is make sure you pay yourself first. Whatever your plan is, give yourself a little bit of spending money. Make sure you put aside a little amount for the years to come, for the future, so you do have something to fall back on. And it's all about you having a heart-to-heart with yourself and seeing what's more valuable. Would you rather travel when you're 30s and 40s, go out to nice dinners and eat well, and maybe when you're in retirement, you're just living a modest lifestyle? Or do you want it vice versa?
Okay. Yeah, that makes a lot of sense. It's important for people to consider what kind of lifestyle they want to live at different stages in their life. So I'd imagine you invest yourself, in the stock market and in different areas. What are your 3 top picks, stock picks right now?
One, I don't actually invest for myself. I pass it along to someone else. And a reason for that is, I'll give you just say I had a portfolio of Facebook, Netflix, Amazon, and Google. And I always wanted to have 25% each. And one of the 2 stocks did really great last week, so I sell Google. Even though I think it's a great company, I'd buy it any day. So I sell Google on a Monday. Then Avi, you're my client, and on Wednesday we're looking at your portfolio. You're like, how can we boost an equity position? I said, well, let's buy Google. We love it. And if I put that trade in, you're going to cancel that trade for you, because I'm giving conflicting.
Really?
Yes, because the FINRA, SEC compliance issues, like, why is this financial advisor selling an asset and then telling his client to buy it, or vice versa? Well, why did I buy Facebook and I told you to sell it? And so when I invest on a personal level, I pass it along to an investment strategy that I put a lot of my own clients in. So I don't look at it, I don't touch it. Same with my 401k. I set it to be ultra aggressive. I don't look at it, I don't touch it, because then I don't have any conflicts of interest. It allows me to provide more time for my clients, because there's certain advisors that get hooked on being a stockbroker, stock picker. I got to find the next big thing, and then that's taken away from the time that their clients are paying him to be doing on them. And so when I work with someone, I really dedicate all my time in making sure that they're in the right track, that everything's going well. I'm easily accessible on the weekends and things of that nature. And I feel if I was acting like I was in college, I wouldn't be doing the best service to the people I work with.
Okay, so do most of your clients come in with a plan that they want to have you tailor for them, or do most of them have no idea what they're doing?
They definitely don't have a plan. A lot of times I get referrals or clients that I reach out and they say, I have X amount of dollars. This is what's going on in my life. This is kind of what I want to achieve. Dave, like, what do you think is best? And we sit down and we have, one-on-one conversations, usually 2 or 3 meetings before I even decide to give a proposal or talk about investing this money.
So when somebody is younger and they're adding to their 401k or Roth IRA, what would you suggest in terms of what kind of assets to put in their portfolio? Stocks, bonds?
Well, I mean, when it comes to 401k, there is three sectors, or 3 asset classes, I should say, you're going to get. There's going to be equity, there's going to be a fixed income, and then there's going to be a small cash option. All of those are either going to be ETFs or mutual funds. Especially if you're young in your 20s, I always talk to my even clients that are in their 40s. I say, let's be as aggressive as possible in this. You can't really take it out. You can't touch it for the next 20, 30 years. Your options are really slim. So let's maybe put this in some index funds, and let's focus on the assets that we can change and that we can manipulate.
So what are some of your the index funds, ETFs that you offer?
Well, I mean, I can tell you, like, the companies that I like.
Yeah.
Oh, and I would also say, I'm just trying to think how to word this. The popular ones I would say is Vanguard, iShares. I use First Trust a lot personally and for my clients, PIMCO. And what I would suggest people are doing research and looking into this is not necessarily focus on the eternal fee, because there's an expense. Vanguard is known to be, and same with iShares, to be extremely cheap. But you want to look how efficient it is. How do you deal with tracking the market? Are they beating the benchmark? Are they not? So those are the type of things that you want to look at when you're looking at index funds, ETFs, or mutual funds.
Okay. What percentage of your clients or people that you worked with are male and as opposed to female? What do you see there?
I mean, I would say like the head of household or the people I talk to the most when it comes to finance is probably closer to 70-75% male.
Why do you think that is?
That's a good question. I'm not entirely sure. It's not on purpose. It's just the way that the things have fallen. What's most important though is a lot of times the main point of contact I have might be the husband or someone like that. It is working with them as a team. A lot of marriages here, especially in LA, they're both earners, they're team members, they both have a shared goal. And even though I might have befriended or onboarded the husband first, I'm definitely looking at the wife for her advice. How does she feel emotionally? What does she think is best? Because ultimately, it's a shared community assets that I'm working with. And so I have to keep in mind of everyone's feelings and objectives. And I have a fiscal responsibility, not just to the husband, but also to the wife.
So do you find yourself ever having to resolve conflicts between the husband and wife when it comes to how their finances are managed? Like
No.
Conflict resolution, is that a big part of what you do too?
I mean, conflict resolution is a little bit part of it. Conflict resolution is generally when it comes to intergenerational investing. It's not so much the husband and wife will have really any conflict. Of course, the husband might prefer one thing over the other, and same with wife. And it's just talking about like a middle ground or why one thing might be better. Generally, the issues come with grandparents passing along to their kids or their great grandkids, or grandkids, I should say. And that's where there's a lot of conversation. There's family planning that's involved in legacy. Like I said, it's important for everyone to know what their portion is and what the purpose of this money and how it should be used. And then now we're getting into like living trust, irrevocable trust, and things of that nature.
Okay, so when it comes to establishing trusts for your children, when should you do that?
I would say, if you're in the beginning of your career and you're starting to build up a little bit of emergency fund, you're starting to invest a little bit, I would definitely, if you're a family, if you're a single guy, single woman, start putting things in a trust, especially if you start buying property. You're going to want to utilize either a trust or a business entity for tax purposes and for other reasons for passing along and making the records a little bit more difficult for people to cold call you and try to market you some crazy loans or stuff.
Okay. So how early also should you look at getting life insurance? because you can lock in a cheaper policy if you're younger, right? And keep
a term policy. Life insurance there's multiple different reasons why you might use it, but for a young person, if you're single, you might want to get like a low term policy and maybe help out your family, someone that you care about. For a young family, you would definitely want to look at a term policy, 20, 30 years. And during that time, you have a low premium, and the extra money you're having is you're building up your investment portfolio.
So are you do you find yourself often advising people to establish their trust for their kids if they don't have one, or do they just come to you and say, hey, I want to start this? Are people proactive with what they're doing?
In Los Angeles, a lot of my clients already have trust. They're already well aware. Only a few have I, onboarded and talked to weren't utilizing a trust, and that's immediately the first thing that we talk about. I find I have clients all around the country that more on like the Midwest, where it's a little bit of a slower vibe. People are doing 120s and 30s just because, living costs. My best friend just bought a house yesterday, and I was speaking to him and his wife 6 months ago, like, hey, you need to set up a trust. You need to do all these things. And so hopefully he did it. I don't know if he did or not, but, I warned him.
Okay. So when it comes to teaching people about financial literacy, what are some resources that you suggest that people use to learn those kinds of things?
Wow. The one website that I think is great is Investopedia. And generally, if you Google whatever financial term or issue, Investopedia will have a great article on that. Another thing is YouTube. YouTube is great. That's how I learned a lot, when I was in college. And it just depends on what exactly you're trying to nail down, because finance in general is such a broad-based term. I would probably probe a little bit more and see what questions are they trying to ask before I give them, an answer.
Okay. So where should people avoid in terms of getting knowledge for their own financial literacy?
Social media.
Yep.
Without a doubt. Social media,
Yeah.
I'm not big on Instagram or Facebook, but, I do scroll through, especially with Instagram. There's so many fake gurus that talk about Forex trading or Bitcoin, and it's so easy to manipulate, their returns, or they're just showing you a little snapshot. Or they'll say, join my course for $25 and I'll teach you the trading secrets. A little secret here in finance, if you were as good as you are as a stock picker, you wouldn't be having time, or you wouldn't be needing to create a course.
Yeah, that's what I always say.
And if you're as good as you say, and this is why I was taught in college, Dave, if you're good at stock picking, start a portfolio, do it. And then you go to hedge funds. You go to private equity, but hey, this is how good I am. And if you're truly as good as you are, they'll hire you. You don't care if you have a degree or not. If you're able to make money, if you know what you're talking about when it comes to investing, they'll bring you on board. And you can make a lot of money doing that.
Wow. Yeah, that goes out to all the fake gurus out there, pushing fake nonsense. It's misleading a lot of people. People who are regular people that want to learn are being misled. And I think it's important for them to put their money where their mouth is if they say they're so good, right?
Yep.
So, yeah, I mean, avoiding social media is a good start. I mean, avoiding people who you don't trust on social media and not putting your trust in people who haven't earned it, right? So you said you learned a lot online. You learned a lot from other things that you've seen, just in your own research. Where can people go to find the best financial advising firm and really learn before they even get there?
Financial advisor firm, to find a financial advisor?
Yeah, through a firm.
I mean, I would argue, and I talked to a lot of clients about this, and I mentioned it earlier. It's kind of like your banking experience. There's some people that absolutely hate Bank of America. There's some people that absolutely hate Chase. Name whatever bank, and you will hear the horror stories. And the same thing is true within a wealth management. I'm sure there's people who absolutely hate Merrill Lynch, who I work for. There's some who hate Wells Fargo. The most important thing is finding a financial advisor, researching his background, and just giving him a call. Just seeing what his philosophy is. How does he treat his clients? you ask, how often do I talk to my clients, or how often a financial advisor? And those are all great questions, and ask what their investment philosophy is. A lot of times, like I said, you will find advisors that have their own set of personal portfolios that they created. They might be great. I'm not saying they're bad, but if it doesn't fit with what you like or what you need, then they're not a good financial advisor. And I'll give you an example. A lot of financial advisors will set in their own portfolios and use mutual funds and ETFs. Or there's some that will use only individual equities. Well, if you're an aggressive investor, you like taking risk, it doesn't make sense for you to go to the guy who is only offering mutual funds or ETFs. Or maybe you don't like the bottom-up approach. You think it's really volatile and dangerous to own individual stocks because then you go to zero. You want to be a broad-based investor. So you don't want to go to the financial advisor that's only, pitching you individual equity strategies. And, the one thing I've learned, and I do for a lot of my clients, I would say about, 2/3 of my clients are comfortable with our aggressive, individual equities, but I have almost, like I said, 1/3 that would prefer broad base. We use a lot of mutual funds, ETFs that I build out specifically for their situation, what they're comfortable. Sometimes they're very cost conscious. Even though I can show them that this mutual fund might charge you 0.5% and will do great, they don't care. They want something that's charging only 0.1. And so, I'm here to find those solutions that make them feel comfortable and still allow us to achieve the goal and the reason why they came to me.
Okay, so what are some red flags, some extra red flags that somebody can, look at when finding a financial advisor?
The number one, if they're really pushy, if they're really salesy, and you're going to notice this once they're talking to you. Another problem or issue is that they're kind of aloft. Like they're talking to you, but they don't really seem like they're there. Or they're pawning off their associate or junior to handle you. Okay. And so those are instantly things that you could gather in the first couple of meetings or just phone calls in general. And that will let you know kind of where your place, where your relationship is to this advisor and the team.
If you notice your advisor is not really kind of neglecting you, not really meeting your needs, how do you handle that as a client?
Well, generally the best thing to do, you could have a talk, but it's time to find a financial advisor that's going to meet those needs that you want. Because you might have a talk and they might give you a little bit more, but it's kind of like when you date someone, they have a really annoying habit. It's going to be hard for them to break it. And same with a financial advisor. They have their own way that they set up their business and how it's going to be run, and they're not going to change it generally for you, no matter what.
Okay, so where can people find your services and your financial advice? Where could they find you?
You could Google my name. It's David Masias, Masias. It has all my information that's easily available there. Broker check, I think.
Okay.
You can look at all my stuff.
Okay.
Too.
Well, David, I appreciate you joining me. Had a great time talking to you. Thank you for all the advice you gave everybody at home. Thank you guys for tuning in to the Honest Earnings podcast, where we talk about financial literacy, saving, investing, entrepreneurship, and personal finance. If you like the video, please leave a comment, a like, subscription, something that lets us know that you enjoyed it. And please reach out to David when you get a chance if you need any kind of financial service. He's an amazing guy. You can see that he's a down-to-earth person, somebody who you can trust. So thank you guys for tuning in. This is the first episode of the Honest Earnings podcast, and I'm out.
Thank you.
Thank you.